All right, what's going on, everybody? Welcome back to the second part of this 6-part series on Index Universal Life. Today, we're going to discuss my favorite thing about IUL, the premiums and the policy charges. We're going to talk about how to differentiate the premium and the cost. We're going to talk about what the actual costs are. And we're also going to take a look at an actual expense report, which outlines line by line how much every charge is, what it's for, and how it actually works into your advantage. So if you're somebody who's been thinking about becoming your own bank and you want to use Index Universal Life Insurance to do it, this is definitely the series you need to watch. Make sure you go ahead, click that subscribe button so you can be notified every time these videos come out. Let's get started. So the very first thing that you have to understand when we're talking about premiums and cost is the difference between those two. And the reason why it's confusing for a lot of people is because of your health insurance, your dental insurance, your car insurance, your home insurance, and 99% of life insurance policies, the premium is actually what it costs. But in an IUL policy, the premium is not what it costs. The premium is just what you pay, because an IUL has a flexible premium. What that means is you have a minimum premium that you can pay, which only covers the cost of the insurance, and that's set by the insurance company. But then you have a maximum premium that you can pay into your policy, which is set by the IRS. And so that maximum premium that you can pay is really going to be based on 4 different factors. Number one, the size of the policy, meaning the death benefit. Then the other 3 factors that go into this are going to be your age, your health, and your sex. Generally speaking, your policy charges will be about 10% of whatever the total premium is for the year. So in other words, let's just say that your maximum premium for your policy is 10 grand. That might cost $1,000. So as you're paying this $10,000 throughout the year, minus your costs, that means there's $9,000 of cash value. And this $9,000 of cash value will typically earn anywhere between 0 to 10%. Remember, we covered the index crediting and how that worked in the first video. If you didn't catch that, definitely go back and watch the first video to understand how that $9,000 can actually cover the cost as it earns compounding interest over time. So remember, I said that an IUL has a flexible premium. What that means is you have a minimum premium you can pay, and you also have a maximum premium you can pay. The insurance company only cares about the minimum, which is enough to keep the policy in force, whereas the IRS cares about the maximum because they want to make sure that you're not using this policy as an investment. If we use it as an investment, then it will be taxed like an investment, meaning it could be subject to 10% penalties. It'll be subject to taxes. Now, there are going to be some instances where you would want to treat a life insurance policy as an investment. We won't talk about that today, but just know there are specific scenarios when you would want to go over the maximum premium that the IRS allows for a policy. But today we're just going to talk about staying within that range of being in the minimum and the maximum. So basically what we're looking at is a life insurance policy for a 35-year-old male where the death benefit is $1,097,504. This is for a gentleman who intends to pay a total of $60,000 worth of premium throughout the year. He doesn't have to pay $60,000 per year into his policy. He can pay no more than $60,000 a year into his policy, assuming he wants to keep the tax advantages, which in this situation, ideally, he wants to keep the tax advantages, okay? So that death benefit of $1,097,504 sets a maximum premium contribution of $60,000 per year. You also have a minimum premium. And for this particular policy, the minimum premium is only $3,505 for the year. What this does is it only covers the cost of the policy, and it only covers the cost of the policy for 10 years. You will build no cash value if you fund at the minimum. Okay. Let's just say, for example, we wanted to fund more than the minimum, which if you are getting an IUL, you should fund it more than the minimum. Okay. But the cool thing is you get to set the minimum. So you can choose if you want the minimum to be $1,000 a year, $500 a year, $10,000 a year. You get to set the minimum. Okay. You also have this no lapse guarantee premium. Some insurance companies have this, some insurance companies don't. Basically what they're saying is if you pay $5,215 per year for this example, then we will guarantee that your policy will never lapse. It'll stay in force. All right. So typically this is a good way to get more death benefit by paying a guaranteed lower premium than what you would comparably get in a whole life policy, which has a guaranteed permanent death benefit. Okay. So this will create some minimal cash value. Now, once we get up to the third level here, where it says target premium, this is ideally where you want to fund it at. You don't want to fund any less than whatever your target premium is. This is enough to create good cash value, meaning you're paying well above the minimum. Remember, anything above your minimum cost for the year goes into your cash value, and your cash value is what earns compounding interest. So we're about $7,000 above the minimum. We're $5,000 above the no lapse guarantee. So here's where we start seeing good cash value, meaning you're able to put in money, start seeing some pretty good growth, and being able to access money, borrow against your policy. Okay. Now, here's the thing. A lot of people stop funding at target, but this is where the magic happens. Right above your target premium, up to your maximum premium, this is called excess premium. Excess meaning what? Extra premium. Extra premium meaning what? The insurance company doesn't even need the premium. It's extra. All right. So they're going to pay you extra. Well, I wouldn't say they're going to pay you extra. Anything above the minimum is going into the cash value, and that's what earns index crediting. I'm going to keep saying that over and over and over and over again. And the reason why I'm saying it over and over again is because sometimes people get a policy and they only fund it at target. They forget that they can put in all this extra money throughout the year. And so they just don't do it, or they forget to do it. One or the other, doesn't really matter. The point is, when you don't fund it up to the maximum, there isn't a lot of magic happening. So ideally, this is how you would look at it. Because I know we're looking at a big policy here with a $60,000 premium limit. But let's just say, for example, we were to take off 10. So instead of having a $60,000 premium limit for the policy, what if it was only $6,000 as the maximum limit? How would that affect the numbers? Very simple. The numbers would be affected by moving this decimal place one space to the left, right? So our max premium would be $6,000. The minimum premium would be $350 for the year. The no lapse guarantee premium would be $520 for the year. The target premium would be about $1,074 for the year. And then you'd be able to put in up to $4,000 extra, filling up your limit. And so the reason why I'm mentioning that is because it doesn't matter how much money you have or how much money you want to fund it. You can set it or design the policy to where you're max funding the policy. And remember, max funding is what you want to do if you want to use your policy for cash accumulation, if you want to use the policy to borrow against, if you want to use the policy to be your own bank. All right. So just keep that in mind. We're going to look at some examples later in the series to show you the thought process of how you can go about choosing a nice size premium that fits within your goals. All right. But this is the main thing that you have to understand about the premiums. Now we're going to take a look at an actual expense report to show you line by line what all the charges are, what each charge is for, and how it actually works into your advantage. So what we're looking at is the actual expense report for an index universal life insurance policy. But before we look at the numbers, I want to explain each charge and what it is for. Okay. So the first charge you'll have is called a premium charge. And so a premium charge applies to all premium payments to reimburse the life insurance company for any state premium taxes or any other administrative expenses. Different insurance companies charge different amounts for premium charges. I've seen them anywhere from 0% premium charge all the way up to 30% premium charge. But in general, you should expect anywhere between 5 to 10% on average. You also have a policy issue charge. Some insurance companies call this a price per thousand. Some insurance companies call it an expense charge. But really what it is a fixed amount to help cover the cost of issuing, underwriting, and distributing the policy. So what does that mean? It means that if you need a medical exam, somebody has to come out, see you, take your blood, height, urine, do all those different things, that has to be paid for. The insurance company actually pays for that. And so they price that into issuing all of the policies that they issue throughout the year. There's people at the insurance company called underwriters who actually look at your motor vehicle report. They look at your medical report. They look at the guidelines to make sure that you are eligible for a policy. And those people have to be compensated, right? So that's how they get paid. And then distributing the policy. If you're ever watching the Super Bowl, if you're ever watching TV and you see logos like, actually maybe that's a bad example. This goes into marketing, right? This goes into advertising. This also goes to the insurance agents who actually help distribute, write, and service the policies. This goes towards that. Now, this charge only applies for the first 10 years of the policy or for 10 years after face amount increases. Like if you start with a lower face amount, you want to increase the face amount, then you'll have more charges for that. But generally after 10 years, insurance companies drop them out completely, or maybe it goes to something like $5 a month or $10 a month. You also have additional charges, which would be riders. So sometimes there's things like child riders, where if you want to add on your child and insure your child through your policy, you can do that. There's things like terminal illness riders, where if you ever get diagnosed with a terminal illness and a doctor says you got 12 months or less to live, you're able to use your death benefit while you're living. Critical illness, if you ever have a heart attack, stroke, cancer, lose a limb, things like that, you also can get a portion of your death benefit while you're still alive. Another one, big one, is a chronic illness. This is more like a long-term care. Typically, as we get older, we may need somebody to come live in the house with us to help us with eating, help us with bathing, maybe even getting in and out of bed, walking, those things like that. That qualifies as a chronic illness, which means you're entitled to the death benefit of your insurance policy while you're still alive. That way, you don't have to go into your investments. See, a lot of times people try to compare life insurance to investments. And life insurance is insurance for your investments. Because if you get sick, injured, disabled, or die, then your family might have to sell your investments to cover the cost, which means what? They could sell them at a bad time, meaning they're selling them for less money because they are forced to sell it. Whereas if you have an insurance policy that can step in when you're facing a crisis and a life event, you can use the insurance policy to pay for those things without needing to sell your investments. Right. So that's how you want to look at an insurance policy and like why you need to have one if you're talking about making big money and doing big things. If that's not your thing, you know what I'm saying, then you really don't need a policy. Definitely don't need a policy like this. All right. So those are just your rider charges. Also, if you want to have access to your cash value earlier, there's rider charges so that you can do that. OK. Now, some companies have what you call bonus credits, which is sometimes it's guaranteed depending on the contract. Sometimes it's not guaranteed, which is a reimbursement of expenses. And this is typically available after the 11th year. Some companies have them available after the 5th year. But really all it is a reimbursement of expenses. It's the insurance company saying, hey, we charged you too much money this year. We're going to reimburse you in the form of a credit. And that's essentially it. Now, one thing to note and be mindful of with index universal life policies is that the charges can change depending on the profitability of the insurance company. That's why it's important to always look at the guaranteed maximum allowable charges in an IUL policy. All right. So as we walk through the expense report, I want to show you how small and insignificant the charges are in relationship to what we get in return. Okay. So for this 35-year-old male, with a $1 million death benefit, the maximum premium allowable is $63,340. The premium charge, remember, that's the automatic charge that is deducted to reimburse the insurance companies for state and local taxes. And I actually should have mentioned this. The reason why they have that state and local tax is because insurance companies are not regulated by the federal government. They're actually regulated on a state level. And every insurance company has to be approved by the state's Department of Insurance in order to operate in that state. And so each state has an insurance guarantee fund. Guarantee is spelled G-U-A-R-A-N-T-Y. Let me write that word up here. Guarantee. I would say do a little bit of research on that in your free time to see exactly what that means. But in simple terms, it is to insure insurance companies if they were to ever go insolvent. Hopefully that makes sense. Okay, so as that money goes in, it's going to be charged whatever that percent is. The one we're looking at right now is about 5.5% of that premium number. The second one is going to be your cost of insurance, and we can see that's $208. And that's for the year. These aren't monthly charges. Remember, these are yearly charges. Your policy issue charge, $2,330 for the year. Additional charges, so these would be like any riders within the policy, $735 here. Okay, so that's what's being deducted, and then this is what's being credited based on a 6% return on your cash value. So you can see it's not a lot in the first year. Actually, in the first year, you're paying more in costs than what you actually earn, assuming you earn 6%. And so that's typically why when people look at an IUL and they say, well, it's a bad investment because you're negative in the first years, I guess the logic behind it. However, you have to take in consideration that the money didn't just disappear. It's actually covering a $1 million asset that you can leverage at any point in time. So why is that important? Well, let's just say, for example, you can borrow that amount at a cost of 5%, but you can earn 6% on that total amount. Well, that means even if you're borrowing the money, you're still making money on what you borrowed. That's called leverage, and that's essentially how and why I became my own bank, because I wanted to be able to leverage every single dollar that I got my hands on. Okay, let's go down to year 5. So by year 5, we would have paid a total of $316,699 worth of premium. We would have paid a total of $17,418 worth of premium charges. We would have paid a total of $1,300 worth of cost of insurance charges, another $11,650 of policy issue charges, and another $6,459 worth of rider charges. So if we total all these numbers up, what do we get? You might want to check my math, but based on my calculations, the total charges through 5 years is $36,844. That was the cost. But assuming we earn 6% interest compounded over that 5 years, we would have been credited a total of $57,777. Meaning what? It means we made $20,933 tax-free by owning and investing cash in a index universal life insurance policy. And you could also see that reflected in the cash and surrender values over here to our far right. So again, if we were to take that total of $316,699 of premium paid and add in the $20,933 of profit that we made net of costs, that means we would have $337,631 of cash value at this point. So we got more money in cash value than what we actually paid out of pocket. Meaning what? The insurance policy is paying us to have it. And we still got our $1 million asset, our $1 million death benefit here. Okay. Now, as we walk through this, I want you to notice how even after 7 years of paying this premium, we got no more premium going into the policy, right? See, beginning here in year 8, there's no premium being paid. And because there's no premium being paid, there's no premium charge. Now we still have our cost of insurance. We still have our policy issue charge, and we still have our rider charges. But again, we're earning interest to cover those charges, actually more than cover those charges at that point. Now notice in the 11th year, what happens? We still got our cost of insurance charge, but now we have no policy issue charge. We only have rider charges. We're now eligible to receive this bonus interest credit. And this is just the insurance company that I'm looking at. I got a policy with them, but I also have policies with other insurance companies, IULs, that also offer something similar in terms of a bonus interest credit. Okay, but you see that credit comes in. Now this credit is not guaranteed, obviously, but none of this stuff is guaranteed. It's all hypothetical based on historical data. And so always be mindful of that. But that's pretty much it, you guys. We talked about the difference between the premium of a policy and the cost of a policy. We talked about the differences between minimum funding and max funding. And then we also looked at the actual charges line by line to see exactly what they are, how much they are, what you get in return, and how it works to your benefit. Now in the next part of this series, we're going to discuss loans. I always say that this was my favorite, or talking about the premiums and talking about the charges was my favorite. Actually, loans might be my favorite. Accessing the cash value out of your IUL, because there's so many ways that you can do it. And once you understand the loan part, then you understand how cool it is to actually become your own bank using Index Universal Life. So I'm looking forward to that. Definitely, if you want to be notified for when that video comes out, make sure you go ahead, click the subscribe button, so that way you can be notified every time these videos drop. So I appreciate your time. I hope you got a lot of value out of it. Can't wait to see you guys soon.